In the energy quadrant today, sideways trading crude oil. Crude basically ended unchanged, down really 0.02%. Crude oil's traded in the same range since about mid-February. Around February 15th, crude oil jumped up from the low 50s into the 54 and change handle, getting up as high as 57.88 a few days ago, and it has existed in that range ever since then, trading for almost a month, just back and forth in this channel, waiting for either demand to pick up, the crude oil cuts to bite, or for the continued increase in production out of the U.S. and Canada. Canada cut temporarily, but their overall production was up from 2017. So looking for those things to either take the trade one way or another. The seasonality is slowing down now, as March tends to be a sideways month. It's been a tailwind prior to that, but other than that, we haven't had any impetus for a breakout. Now, there might have been a little bit of news about the supply gut. A note from Goldman Sachs that was made public claims that OPEC will be able to clear that supply glut by mid-April. So that was interesting. You're looking at the OPEC cuts being a lot stronger than expected, a lot more compliant. OPEC had already cut, specifically Saudi Arabia, had cut production dramatically in December. They cut again in December. We don't have final February numbers yet, but it looks like they've cut even more throughout OPEC in February than they did in January. The previous cut had 116% compliance rate to it, and this cut seems like it's on that same sort of a pace, but they may not only reach the production cuts promised, but they may exceed that. That's part of what's in that Goldman Sachs note to its clients that again was made public. They may clear that glut out by April. Now, if demand continues to fall, it's obviously a factor in the glut as well. U.S.-China trade talks has quite a bit to do with that. And then the U.S.-Europe trade talks, specifically hitting German automakers, which would be the next round of trade talks, would probably hit that as well. And then lastly, we've got EIA coming out tomorrow. S&P Global Platts has an estimate of a 1.1 million barrel draw and a 500,000 barrel draw in gasoline. Crude oil draw was the 1.1 million, and a refinery utilization drop again of 0.2%. That would take it to 86.9. Refinery utilization is a leading indicator of crude prices in the front month. All else equal, with speculative factors taken into consideration, if we continue to see that refinery utilization number fall, that means demand, immediate demand at the refinery level, is falling as well. That means in the future possibility of more builds, possibility of lower prices.